Welcome back to The Explainer. Today, we're jumping right into a massive, frankly, fascinating contradiction that's totally defining our financial world right now. So on one hand, we've seen this unprecedented rocket ship growth in major indices, the S&P 500, the Nasdaq, the Dow. But lately, that growth is colliding with some really wild fluctuations. There's this palpable tension in the air. It's a crazy mix of extreme market optimism clashing head-on with an undercurrent of deep-seated fear. So what are we missing here? What unseen risks are just kind of lurking beneath the surface of these soaring valuations? Well, to figure that out, we're going to unpack a highly specific, very urgent warning from the investing legend himself, Warren Buffett. Stick with me because understanding this hidden danger, it could absolutely change how you look at your portfolio today.
Okay, let's get into the numbers. To really grasp just how confused the market is right now, check out this data. This is from a June 2026 survey by the American Association of Individual Investors, and it paints a picture of a deeply divided landscape. About 45% of U.S. investors are feeling optimistic about where the market's heading over the next 6 months, but right on their heels, you've got 36% who are decidedly pessimistic. And then another 19% are stuck right in the middle, feeling totally neutral. We're essentially looking at a market that's fundamentally torn in half. Half a room is cheering for the recent growth, and the other half is just bracing for impact.
But hold on, because that optimism we just looked at doesn't tell the whole story. If you glance over at CNN's Fear and Greed Index, which tracks investor sentiment across a whole bunch of stock market indicators, it's flashing a very different signal. Actually, for most of June, this index has been stuck firmly in fear. So why the massive disconnect? Well, honestly, Wall Street experts themselves are completely split. They're fiercely debating whether we're currently riding an inflated AI bubble or if the market actually still has significant untapped growth potential. It's exactly this confusion, this relentless tug of war between hype and fear that makes trading right now so incredibly tricky.
Chapter 1. Buffett's Warning, Hidden Risks. To make sense of all this market noise, we really need to turn to someone who has navigated pretty much every type of economic weather imaginable. Now, when you think of an icon like Warren Buffett, you might just naturally assume his biggest fear is a stock market crash, right? Or maybe falling prices. But actually, scratch that. That's not it at all. For a patient investor like Buffett, a falling market is literally just a giant clearance sale, a chance to buy cheaper stocks. His real fear, the thing that actually keeps him up at night, is way more elusive. Way back in his 2002 shareholder letter, Buffett called this invisible risk. It is the ultimate threat to a careless investor. The most expensive risks are the ones that simply do not appear on any balance sheet. You are not going to find them in any quarterly earnings forecast. They just sit there, unpriced, totally invisible, and they accumulate right beneath the surface. And they stay entirely unnoticed until the day they finally surface. And when they do, they drag everything down with them. That is the true hidden danger of getting swept up in market hype without checking the underlying foundation.
And the thing is, Buffett isn't just reminiscing about the past here. He's talking about right now. At a recent Berkshire Hathaway annual meeting, he dropped this chilling 11-word warning during an interview with CNBC. He said, "We've never had people in a more gambling mood than now." Let that sink in for a second. He's looking at our current landscape, the blind optimism, the AI hype, the volatile trading, and he's seeing that invisible risk piling up fast. Investors are being pulled away from sound, boring financial principles and lured straight into high-risk short-term bets.
Moving on to Chapter 2, The Church and the Casino. To really drive this point home, Buffett used this brilliant, highly visual metaphor during that same interview. He didn't just rattle off financial advice, he gave us a way to actually picture the psychology of the modern stock market. He described the market as a single building, but with two entirely different rooms operating side by side. On one side, you've got the church. The church represents the quiet, patient, long-term investment approach. It's all about a reverence for solid fundamentals and sustainable growth. But right next door, sharing a wall with the church, is the casino. And the casino is all about the frantic, high-risk energy of people making short-term bets on crazy volatile stocks. It's the thrill of trying to time the market and chasing the high of a quick return. And Buffett's warning? He's saying that right now, the casino is absolutely packed to the brim, and the noise in there is completely drowning out the quiet work being done over in the church. So the takeaway here is absolutely crucial. When you spend all your time hanging out in the casino, you are exposing your money to massive invisible risk. Sure, overvalued stocks might see a temporary surge just purely off hype, but historical data proves over and over that those price levels just aren't sustainable. Buying into these stocks at their absolute peak is incredibly dangerous. Why? Because when the market inevitably turns, when a bear market or an economic downturn rears its head, those are the exact stocks that suffer the most brutal drops. The casino players are left completely exposed the second the music stops.
Chapter 3. Lessons from the dot-com bubble.
We've actually seen this exact casino mentality take over before, and the fallout was devastating for anyone who ignored those hidden risks. We really don't have to guess what happens when hype outruns fundamentals. If we just look back at the dot-com crash, it's basically a perfect roadmap of invisible risk suddenly becoming very visible. Think of it in steps. Step 1. Tech firms hit completely unprecedented valuations, driven almost 100% by hype instead of actual revenue. Literally everyone was in the casino. Step 2. Reality inevitably sets in. The bubble bursts and drags the whole economy into a nasty bear market. Then step 3. The fallout. Because these hyped-up companies had massive stock prices, but absolutely zero robust foundations to fall back on, they just failed. The risk that wasn't on the balance sheet surfaced, and it completely wiped out the folks playing for short-term gains.
Which brings us to Chapter 4, the long-term playbook.
Okay, so if the market is basically acting like a casino right now, and invisible risks are piling up, what's the actual game plan? How do we take this billionaire-level wisdom and turn it into clear takeaways for our own portfolios? Well, we have to step out of the casino and adopt a strategy that shields us from these unseen dangers. Our sources lay out 2 essential strategies to guard your portfolio during this exact type of volatility. First up, you have to invest in high-quality companies with bulletproof fundamentals. We're talking about businesses that have sustainable models and highly effective leadership teams. Usually, the most promising stocks are the ones that are undervalued or fairly valued, definitely not the ones riding a massive wave of overvalued hype. Second, you have to hold on to your investments during the turbulence. Preparing for a downturn means totally tuning out the short-term market noise and focusing strictly on the long-term success of those solid foundations you invested in.
Now, I know this requires a pretty major shift in perspective, but look, no market indicator is perfect, and nobody, literally not even Warren Buffett, can tell you exactly where the market is going to be in a year or two. Because short-term predictability is a total myth, Buffett has always pushed for a buy and hold approach. In fact, he famously says that his absolute favorite duration for holding robust, high-quality stocks is forever. If you buy a truly great company at a fair price, you don't even need to sweat over what the market decides to do next week or next month. And if you need hard proof that staying in the church beats playing in the casino, just look at this staggering number, 758%. That represents the S&P 500's total returns over the past 20 years, right up through the first half of 2026. Think about that for a second. Despite the 2008 financial crisis, despite a literal global pandemic, despite crazy inflation and multiple bear markets, patient investors still saw massive returns. This number is just the ultimate mic drop. It proves that staying invested in the broader market over the long haul is significantly more powerful than frantically trying to time its ups and downs.
So, we've looked at the intense contradiction of optimism and fear in today's market. We've dug into Buffett's warning about those invisible accumulating risks, and we've seen the undeniable historical proof that a patient, long-term strategy actually works. So I want to leave you with a question to really challenge your own financial psychology today. When you look at your portfolio, especially with the market feeling more and more like a casino, are you just placing a short-term bet, or are you investing forever? Thanks so much for joining me for this explainer. Keep learning, stay focused, and I'll see you next time.